Welcome to IFA TV, where we replace speculation with education. Today we have a special guest, Mark Hebner, founder of Index Fund Advisors. I had been with IFA for about 10 years and had been wanting to interview Mark for a very long time. And thank you, Mark.
Thank you, Venkat. 10 years already, huh?
Yeah, 10
it's
years.
Amazing.
Yeah. So tell us about yourself and why you started IFA.
Well, let's see. A lot of people say I'm the most energetic person they've ever met. So I got to do something with all that energy, and what I like to do is apply it to business.
Okay.
I've had multiple businesses over my career, but this last company for investing has been the most rewarding because I've been able to help so many people understand how markets work. And it's amazing how few people actually understand the most critical element, which is that all the news and all the information is reflected in the price almost instantly.
Yeah.
And so everybody want to talk about events and qualities of companies when in fact all that information is all in the price, so it's useless.
Yeah.
And that's, I think, the most missed idea when people think about how markets work. But what happened is way back in 1998, a good friend of mine had an unfortunate event in her life, and she lost her husband, and she called me up to ask me to help her with her investments. And at the time, I was kind of wondering myself what my broker was doing with my own investments. I had sold my company about 13 years before that.
And that was back in
1985.
85,
Yep,
okay.
yep. I
And
was
you got-
very fortunate. I tell this not to brag about
Yeah.
it, but to talk about my opportunity cost. In 1985, I sold my share of a publicly traded firm, of which I was the president and CEO, for about $6 million. And to my shock,
How old were you then?
I was 32.
32.
Yeah.
Okay.
And to my shock, when I started digging into what I would have ended up with had I invested the way we're now advising clients to invest, which is basically a portfolio of index funds based on your risk capacity. Had I done it that way, I would have ended up with about $30 million more money than what I ended up with. And I was shocked, literally shocked. And as I read more and more about the subject, I read Burt Malkiel's Random Walk Down Wall Street. And
So you started reading these books after your friend asked you to help her with investments?
That's
or you-
right.
Okay.
That's
Okay.
right. Because I really felt obligated to her that if I'm going to give her advice, I better really research this. And so as the story goes, I went into Barnes & Noble and walked out of there with 22 books, bags full of books, and took those home and started plowing through them. And the amazing story is that we pay managers to beat markets, and in fact, markets were beating managers.
Yep. And clients.
Yeah, well, and clients, of course, but the main thing was, we pay a professional manager, to earn market-beating returns for us and to get this alpha, as they call it. And it turned out that really the only managers that had earned alpha had earned them out of pure luck.
Yeah.
And luck doesn't persist. And so another great lesson that I picked up early on.
So how long did it take for you to come to the realization that what you had been investing yourself, like, about 6 months or a year or?
I would say it was probably 4 months.
4 months.
4 or 5 months,
Okay.
something like that.
Okay.
For me to research that, the internet was just becoming available
Yeah.
in 1998. I
Yeah.
remember going on my computer and running little charts, here's the S&P 500 over this period, here's what I did in my equities. And I'm going, what is this? You know, it was
So
really eye-opening.
Is it correct to say if your friend didn't ask you to help her out, you would have not taken this route of starting IFA?
It is very likely that that would be the case.
Yeah, okay. And how did you come across DFA?
So as I was reading through all these books, I ran across one book that talked about a unique indexing firm that was recently developed. I mean, they started in 1981, and so they were, I don't know, maybe 27 billion at that time. Today they're almost 600 billion. I think it's 570, something like that.
And which book is that?
So I don't even remember the name of that book. It was probably an author that was already at a firm that was already working with Dimensional, something like that. And they mentioned this select group of advisors who were approved to invest their clients' assets with Dimensional. And even that made me kind of wonder a little bit, how could this be? Why would they have some select group? Well, as it turns out, they're selective because they don't want to bring in investment advisors who think they can time the market or think they can pick stocks or pick managers and all that stuff. They wanted somebody who understood all of this academic research that was the premise for the development of all their products. And that's not easy either, to get through all of the research that led to David Booth and his team to develop these various unique indexes and then funds that track those indexes.
But it worked out well, right? I mean, David Booth, he started back in 1981, DFA.
Yes.
And they introduced investment advisors like IFA back in 1990 or?
No, we started in March 5th of 1999.
99.
Yeah.
But when did they start?
In fact, we have our 20-year anniversary coming up in March of 2019. Will be 20 years since the day I incorporated. We didn't really do any investments till November of that year, but that's pretty amazing too. It's been 20 years that we've been doing this.
So that's what you read a book and you wanted to inquire about DFA and you attended a conference, educational conference, and that's how you started IFA.
Yep.
Has anything changed since 1999? It's almost 20 years with investing, and any thoughts or any observations?
Well, so it depends on what aspect. I mean, we've had multiple companies come and go. I mean, Apple Computer was out there, but it was so small, and today it's this behemoth corporation. There are a lot of changes in the capital markets among companies, but what hasn't changed is the mechanism, the process we see in stock exchanges all over the world, where a willing buyer and a willing seller both bring their information and their forecasts to a trade, and through this process discover a price that's fair to both of them. And this is so confusing to people also, because they say, well, times have changed. Things are different this time. Well, what's not different is the mechanism through exchanges that allow people to price these events and price this information. And that's been there since the first publicly traded exchange in 1602 in Amsterdam at the Amsterdam Stock Exchange. And so, there hasn't been a whole lot of changes. Now, when we first started with Dimensional, they were focused on small companies and value companies among equities, but they've recently added, I guess it's been 5 years now, a profitability factor to filter or to screen in their indexes to add this profitability. So if anything, I think that has been a change. I think the other major change is the recognition among financial journalists and the investing public that passive investing is a superior way for them to earn the returns that are available to them in the capital markets.
Good. I know hindsight is 2020. Would you have invested differently with the payout that you received in 1985?
1985.
Yeah.
1985. Well, of course, now that I know what I missed out on, and now I know all of the errors made by investors, it's a lack of education about how markets work, but there's also this gut reaction, what's often referred to as behavioral finance. It plays such an important role in investors being able to capture the returns of the market.
Yeah.
It really goes against our emotional makeup to want to hold on to volatile markets so that we can earn our return.
Yes, compounding takes time.
Compounding takes time, and
very long
after
time.
markets have dropped,
Yeah.
we think it's going to keep dropping, so we're going, oh man, get me out of that.
Yeah.
After they've gone up, we think, oh man, that's good, let's get some more of that.
Yeah.
And this extrapolation of a trend has been the Achilles heel, I would say, of investors. It's really ruined their chances of trying to capture the average return of investments over long periods of time.
Yeah. So if you were to invest the $6 million in 1985, what would it be today?
We have a new app,
Yeah.
and so you can actually go on this app now. Just go to the Apple App Store and look up index fund advisors, and you can throw this in here on your phone in just minutes. So if you put 6 million and you put it even on a glide path, so a glide path means, I started, let's say, a portfolio 100 because I was 32 at the time. That's about appropriate. Yeah. And then each year, as I got older, we would reduce the risk.
Yeah.
That 6 million is now worth $237,327,000. That's an annualized return of 11.45. Wow. And that's net of our fee. Now, I just have to assure you that very few people would have ever earned this because they wouldn't have held on to this portfolio through all of that volatility. Yeah. The volatility in the dot-com crash of 2000, the volatility of the 2008, 2009 crash. But that's part of the lesson we've been trying to teach people, step 4 in my book, is that the prices are always fair, and it's always a good time to invest the right way.
Yes.
And so
sit tight.
Sit tight in your portfolio, and it's really amazing.
Yeah, and that's what you do when you get on a roller coaster. You buckle up and sit tight.
Yes, when you're on the roller coaster, that's right.
Yeah, same thing with investing. Buckle up and sit tight.
You got to buckle up. Yep.